You are tuned in to the 5-Minute Signal, Business and Wealth. I am Vivian Thorne, economic strategist. This is not a finance podcast. This is a blueprint for building and defending your economic fortress. We don't do speculation here. We do strategy. 5 minutes on the clock. Let's get to work.
The S&P 500 is currently flirting with the 7,000 mark, a figure that would have seemed like a fever dream just a few years ago. The data coming in this first week of February 2026 suggests a corporate juggernaut that is unstoppable. FactSet is reporting a blended earnings growth rate of 11.9% for the final quarter of 2025, marking the fifth straight quarter where the index has delivered double-digit year-over-year growth. Analysts are already penciling in even higher profit margins for the remainder of 2026, targeting a staggering 14.2% by the fourth quarter. On the surface, the fortress looks impregnable. The Magnificent Seven have successfully transitioned from AI adoption to AI profit capture, and the market is rewarding that efficiency with a forward PE ratio of 22.2, well above its 10-year average.
However, if you look past the neon glow of the ticker tape, a different story is emerging. While the index hits record highs, US consumer confidence has just slid to its lowest level in more than a decade. The January data shows a public that is increasingly pessimistic about the labor market and their own personal financial futures. We are seeing a low-hire, low-fire environment where companies are protecting their margins not by expanding, but by squeezing every ounce of productivity out of their existing footprints and automated systems. Job openings are trending downward, and the unemployment rate is beginning to nudge the 4.4% mark. The engine of the economy, the American consumer, is starting to sputter, while the luxury cabin of the S&P 500 remains blissfully unaware of the turbulence.
This matters because we are witnessing the ultimate decoupling. For decades, the stock market was viewed as a leading indicator of economic health. Today, it is a reflection of capital concentration. Roughly 30% of S&P 500 revenue now comes from outside the United States, and the index is increasingly dominated by asset-light, high-margin technology firms that do not require a thriving domestic middle class to maintain their valuations. When JP Morgan signals a 35% probability of a US recession in 2026, they are looking at the reality of the 99% of businesses that aren't in the S&P 500, the ones facing sticky inflation, cooling demand, and a Federal Reserve that has signaled it may keep rates stagnant at 3.5% for much longer than the market anticipates. Your wealth strategy cannot be predicated on the assumption that a rising index lifts all boats. Some boats are currently being used as life rafts for the elite. The hard truth is that the S&P 500 is no longer the economy. It is a list of 500 winners who have successfully offloaded their labor costs onto machines and their tax burdens onto global jurisdictions. When the index hits 7,000, it isn't a victory for the American worker. It is a testament to the brutal efficiency of capital. The earnings mirage is the belief that because Nvidia or Microsoft is thriving, your local real estate market or small business environment is safe. It isn't. We are entering a phase of growth without participation. If you are holding an index-heavy portfolio and assuming it protects you from a domestic downturn, you are ignoring the fact that the very things driving those stocks, AI-driven job replacement and margin expansion, are the same things that will eventually erode the consumer base required to sustain them. Hope is for the uninformed. Strategy is for the survivors.
To defend your economic fortress, you must move with surgical precision. 1. Audit your equity exposure for participation bias. If your portfolio is overweighted in the S&P 500, you are essentially betting on a small group of tech giants to continue outperforming the general economic reality. Rebalance towards defensive sectors, utilities, healthcare, and essential infrastructure that provide services the consumer cannot cut, even when confidence hits record lows. 2. Shift your primary economic indicator from earnings beats to labor market velocity. Headline earnings are a lagging indicator and easily manipulated by share buybacks, which are projected to contribute 3%. This program is for informational and educational purposes only. This content is not a substitute for professional, financial, investment, or legal advice. always consult with a qualified professional before making any financial decisions.